New numbers from the Census Bureau on new permits and starts for multifamily and single-family housing was just released today. And we're looking at a huge fall off in permits and deliveries for single-family homes and multifamily. This is huge news for the real estate industry and the economy, looking at inflation and interest rates and the rest. We're going to get into what it means and more on the Gray Report. So if you're an active investor, passive, active, anywhere in the middle, if you're in the industry, you're in the right spot every single week on the Gray Report. We're breaking down all the latest research, reports, articles, and then throwing out some original opinions on the multifamily industry, real estate, commercial real estate, and the macro economy, trying to give you the right information to make some really informed decisions. I'm joined again by Director of Communications and Marketing, Gray Capital, Dr. Matt Bosnagel. We're going to be getting into all this and a lot more. Make sure you're subscribed to the Gray Capital YouTube channel to stay up to date. Let's get into it. Welcome back to the Gray Report. Matt, how you doing this week?
Pretty good.
It's Thursday.
Staying busy yeah, keeping up.
Trying to. Good. Well, Matt, we've got a lot of great reports. I only mentioned the housing starts and kind of permits and completions that the Census Bureau put out this morning, but we've got some other really good articles. One from the Wall Street Journal that we're going to talk about that we really wanted to discuss. It's talking about, rent hikes are looming, posing a threat to inflation fight that we wanted to feature because it got a lot of broad coverage, not just from folks in the real estate industry, but also looking at some reports from looking at really kind of some of the fundamentals of multifamily market right now from RealPage, Yardi, and BizNow. But before we get to those, Matt, let's just jump in just real quick, kind of looking at what as the news broke this morning in terms of these new units that are started, but also what is being permitted. So this is just looking at the chart real quick from Fred. This is multifamily starts, not permits, not completion, but just what is started. You can see how these numbers have, been falling off, but it really over this last month really kind of took a major dip. This has a lot of implications, Matt, not just for multifamily, but for the broader economy, for inflation. There's a lot of just economic activity related to construction, building things. You need people, you need materials, but also it shows that we have a housing crisis. We need more. We need to build more housing. Even though we're building a lot right this second, and we have the last year or so, we haven't built enough. And so if we're really slowing down, that's not going to be good for the U.S. or from the renter's perspective. Not a bad scenario for a multifamily or real estate investor, though, because again, as this Wall Street Journal article states that looks like we're going to be seeing some rent hikes are going to be looming here in the near future. Any thoughts, Matt?
Yeah, I mean with the hard numbers at like 19.3% lower than the previous year. That's a pretty sharp drop off for starts. I think that doesn't mean that there is low demand. Nowhere in these numbers does it mean that people are demanding it less.
This is interest rate driven.
Yeah,
right?
It's purely a result of it's higher. It's more costly to get a mortgage. So not only are to get a loan, really, not only are apartment syndicators kind of pressed when it comes to getting something that makes sense financially, but like the average home buyer and even developers and construction firms, they got to get a loan, and interest rates impact all levels of that, so it makes it distasteful on all those levels. And another interesting thing on this drop off is like the conditions were roughly the same this month as it was the previous month, but it seems like things are catching up, and it seems like there is, as Yardi Matrix report will put it, a reaction to higher for longer with maybe lower for longer activity. That's like the fear, and I think it was interesting that Yardi Matrix kind of gave voice to that, whereas a lot of people are thinking, and rightfully so, that all of this demand, it means it's only just a matter of time. But until we see those lower rates, nothing's really going to be unlocked. That's what it looks like.
Yeah, and you are right to point out, Matt, that we've had last month was low also. Now it was just revised down even lower. I think the big piece is here that there's been 3 consecutive months of kind of downward trend, and so there's a real trend that is forming. And so again, going back to the kind of the macro picture of interest rates, when the Fed is looking, is so data dependent, and we need some more data, and we're going to be looking at the data. Well, the housing data, this is the housing data that they're looking at a lot of different things, but they're looking at this very closely because this is a little bit more real time. These are leading indicators, and they know there's going to be a slowdown, and this slowdown in growth and economic activity, they have to weigh that as they seek to achieve this soft landing, kind of feathering the throttle a little bit to not crash the economy.
Yeah, it is going to be interesting to see, because it seems like that's been the paradigm for the past 2 years. Is there has just not been enough, and this is just from the home buying side, there's just been not enough homes for people to buy, and that's just resulted in prices not really being changed, and it just seems like there's just this one linchpin, and that's interest rates, and everything could come roaring back. And that may be the reason why the Fed might be so cautious, is because there's a question there. It does seem like a threshold has been reached where people can't make that purchase or make that jump up because of interest rates, whereas before it was maybe more negotiable, but things are getting, that pressure is building.
I think they're waiting for the whites of their eyes, Matt. I think it's a good point that there's risk in going too soon, is just that you reignite the engine of the economy in a way that overheats, and it's already kind of in that higher gear to potentially overheat. They're really concerned about that. I mean, the stock market's at an all-time high, Matt. It's not like the economy is feeling it so bad, we're all hurting. But then again, how can that be the case if the stock market's doing well? Again, the stock market doesn't reflect the reality on the ground everywhere, but it's certainly an indication of sentiment about the economy. And we talk about vibe session all the time. Well, the stock market's vibing away. I mean, there's no real vibe session going on in the stock market right now.
And maybe that illustrates just how crucial housing is to people's perception of the economy. If they feel locked in, they can't go anywhere else to sell their house because of interest rates. They can't buy a house for that matter. And people are just feel very helpless, and maybe they are actually now dealing with higher payments on their mortgages because they had to move and they have to buy something else, or they're just seeing how their dollar doesn't stretch as far, whether it is from inflation or from the tools being used to battle inflation.
Yeah. Well, so just getting back to this data point before we move on to the Wall Street Journal article, Matt. I want to talk about it a little bit more. I want to speculate a little bit more on. Is it just interest rates? Because, if I'm a developer, I'm a home builder, really thinking about the home builders, but also multifamily developers, they see the market in a similar way that we do, in that, we see some demand. If there is demand, wouldn't you want to say, there's some higher interest rates, but I want to get in front of it and continue to build so I can meet that demand out there? Or are they truly seeing a slowdown in demand? Or maybe there's demand, but not at these interest rates.
See, and that's where I think the whites of your eyes thing kind of does come into play, because they're like, well, if it's just around the corner that we're going to see lower interest rates, I don't want to bother with starting now and get make an unaffordable project start and have to refinance it late in several months or whatever. And they're
not going to date the rate.
I don't think so. I don't think they'll date it. And that's another question. How often can you refinance? What are the burdens of refinancing? And how much time? Didn't
you refinance your house?
Yeah, I did, but I felt I did find
had a great time to do it.
Oh, it was a good time, and I'm glad that I refinanced. But then it was also
your rate is.
No, I don't know exactly, but I know it's low.
Good.
It's very good.
I remember when you did it. It's in the 2s or super low 3s.
I think I remember doing it it's soon enough after I bought it where I was like, is this kind of cheating? And I wonder how many times can you do that? And
as many times the bank lets you do it.
Yeah. But that may be a situation where developers are thinking about like, well, do I start now when rates are at, when it may be 7%, or do I wait until
it would have to give
5?
you some hesitancy just because the buyer pool isn't there like it has been. But there's demand and people want to buy a house, but obviously they're priced out. Maybe you get some people that are waiting around saying, I'm going to wait for the market to come down. But I think a lot of those buyers have kind of said like, I either need to buy now because prices aren't coming down, and then like, I'll refinance later. But prices are actually still coming up. So like, what am I doing? If like I actually have the money to do it, or you're just priced out and it's not an option.
Yeah,
and you're just like,
that's what I think is interesting when as I said, like thresholds. What if it really has actually reached like a meaningful threshold? Whereas before it was like, I don't know, they just keep going up, and the valuations of homes have steadily gone up. They haven't yet gone down in this whole cycle. So it'll be interesting to see if it has reached that point, because if builders aren't starting, and they wouldn't start, or they would start if there were buyers there. So we'll see where it goes.
We shall see. Okay, now to this Wall Street Journal article that we keep teasing. And again, the reason why we're really featuring this, not that because we necessarily think that Will Parker's expertise on the subject is the best. Not saying it's anything other than good, but oftentimes, Matt, we see journalists from media publications that cover a wide variety of industries or topics or whatever, not always understand the nuances of like the multifamily industry, and can get a little confused sometimes. And so we knew that a lot of people were reading this article in the industry and outside of the industry. I think that if you're like considering investing in multifamily apartments, you would look at this and say, this is like probably a really good sign that I should get into the multifamily market right now, because we're really addressing and solving the problems that have existed over the last 15 years or so of we're undersupplied in housing, and we need to invest more into housing. It's not that you're taking advantage of raising the rents. It's that we need to put more money into the housing market, into the system to support the housing supply in this country. And so, it covers, giving the story a little bit about how, rents have declined as of recent. Yeah. Or Matt, you bring us in.
This is a story that we've told so many times.
So many times, every other week.
Yeah. Like places like Apartment List, Yardi Matrix, RealPage, their rent trackers are about a year, maybe a little bit more ahead of the rents as measured by the CPI. And what this article says is that it kind of has its cake and eats it too, I guess, or at least it leaves out this crucial part of this lagging indicator, because its real focus is on how high rents are and how high they're going to be. And they acknowledge that sure, CPI lags current rent growth measures, but then they don't connect the dots and say that, oh yeah, well, this means that rents are headed on their way down. In fact, what I think is they actually did make a good point in this article. They, on the surface, it's another of those rents are too high articles, and they're only just going to get higher. But I think that their point was that rent growth is going to grow from the CPI, which is wrong. But their signs
when they say you call it a rent hike instead of rent growth, it's a connotation.
But their signs, their evidence that they find of this rent growth is actually really valid. They're saying that occupancy is increasing. In short, and what a great explanation, I think. They say in recent months, apartment buildings aren't losing as many residents as they once were. Market reports show, and available units are leasing fast. That's a really good encapsulation of like what's happening on the ground. It doesn't use words like absorption or vacancy or occupancy. It's just like these units are filling up fast, and that is true. But it's going to affect the numbers we see from Apartment List, RealPage, and Yardi, and that which means that the CPI measurements of rents are still going to go down, but the Apartment List ones and the RealPage ones and the Yardi Matrix ones, which are actually of the now, they're going to go up. So I like their evidence. I just don't like the conclusions.
Yeah, it's lagging a little bit. Yeah. Well, it's not exactly in line, but there's a little bit of not controversy, but again, Grant Cardone was kind of making some waves, Matt, kind of the last couple of days. He was quoted he made a prediction that average U.S. rents will almost double over the next decade. And obviously he thinks it's a golden opportunity. That got picked up a lot more from your traditional multifamily economists to make comment on than I thought. Everybody from Jay Parsons to others were kind of chiming in on like what would that take? And and essentially it's going to take above average, historic average rent growth to achieve that, like 5%. But getting into some of the actual analysis, like it's not as far fetched as you may think it is, or it seems today.
Because it compounds over years, and that's
I mean, it's definitely like it would be like not easy to achieve, but it's also not. It would not be impossible to achieve. And there's a scenario kind of given the dynamics, the fundamentals, supply, where you could see it happening. I mean, predicting anything 10 years out is
now
tough.
On the other side of that, I was actively speculating because the current rent growth trends are down, and I will argue that they're improving, especially with the evidence from the Wall Street Journal. But I'd love to know at what point would rents have, if the pandemic didn't happen, if we didn't have this surge in housing demand, if we just kept the 2019 trends, at what point does it intersect with current rent growth trends? Or if it ever will.
When do we revert to the mean?
Yeah.
I think we're probably getting not close, and it's also, it's a separate question, but also relative to income growths as well.
Yeah.
And that's a piece where this article touches on a little bit, but the only way that it could really be facilitated is a continuation of wage growth, in which we have seen over the last couple of years.
That's a good point.
Wages and incomes are outpacing rents, but rents are pretty much flat in inflationary environment. Hopefully, wages are growing a little bit.
Yeah, that's a really good point. Yeah.
So, but and again, it's the higher for longer, or are we going to see an actual, real slowdown that would see a moderation in income growth as well, which we'd probably see more traditional organic rent growth of kind of 2.8 to 3-ish%, depending on the market.
I mean, the way that the charts look themselves, without even understanding the complicated supply and demand dynamics that we've experienced in the past 4 years and ongoing now, it does look like we will preserve some of the unusual rent growth that we had in 2021 and 2022. So I don't think it will ever intersect.
It's
that
never
would
gonna
have been
a full reversion. Yeah, I agree.
But I think that you add to that, like, well, the supply is coming down. We've seen arguably the worst of the from the investor's perspective. We've seen the max apartment deliveries. Likely, if we haven't seen it, we're gonna reach the peak sometime this year, and absorption's coming up to meet it. So there's every reason to see a more balanced, like I said last week, like a more normalized apartment market with maybe more predictable rent growth that's not down at where it is right now.
Yeah, I think the next year to 18 months, I think things will get more clear. Not that it ever is crystal clear, but I think it'll be a little less volatile, over the next year or so. Fascinating, Matt. Well, so Igor Popov from Apartment List was quoted in this article, guest and friend of the Gray Report. But then switching over to an Apartment List report, Matt, I'm really focusing a lot on vacancy, as well as rent, but kind of going straight to the data instead of having it
this is from
put through the Wall Street Journal.
Yeah, this is just wanted to show the contrast here because we covered this, I think maybe, and I wanted to show where these trends are. And this is the exact graph that I had in mind when I was like, all right, so if you see the trends from 2017 to let's say the beginning of 2020, and you draw a linear line, that slope meets where we are, kind of trending gently down since the middle of 2022. Where does that line and will it ever, will those two lines ever meet? And if they do, if currently declining rents continue, we would probably meet that at the end of 2025. I was
going to say, honestly, we're not too far off.
Yeah, we aren't too far off. And I think, but that being said, I still don't think that those lines will ever cross. We're going to revert to a more gradual upward slope that's very similar to what we had in 2017 through 2019. And but we just have to wait till like 2025 for that to happen.
Yes, we will.
If those permits and starts are any indication, which those are sharp numbers, and it's a big, I think it's a big sign of a change.
Agreed. All right, so let's move on to this real page piece, Matt. Most U.S. apartment markets are recording occupancy improvements. That's great that's great news, Matt.
Yeah.
Occupancy improvements again, especially when we're in a period we are delivering more apartments than we have ever delivered, ever. This is by Carl Whitaker, again, another friend of the show. I was just on the Real Page podcast this week. Hasn't been published yet, but had a nice time sitting down with Carl once again, who's been on the Gray Report twice. It was a great time. He was a great host. We talked a lot of stuff about apartment market as well as Great Capital. Be on the lookout for the release of that episode.
Really, Carl Whitaker, Jay Parsons used to be on the team, but there are really this whole Real Page team is great, and there's always like little things that they bring to the table that are above and beyond.
Yeah, I think it's always thoughtful, and they're always looking for like a slightly different angle. They're not just regurgitating the same data.
Yeah.
And like where like,
you know what I liked on this one? At the end, he's like, I always get Denver wrong, but here's why.
Yeah.
And it's like,
I
all
like
right,
that too.
All right, well, you know what? Good. That's how you do a take.
Yeah, no, you have to. I mean, if you're in this business, if you're trying to make any kind of economic, predictions or forecasts, you have to be very extremely humble.
Yeah.
And Carl is that way, and so is Jay Parsons and most of the people that cover this stuff. They always have a little bit of a different take. Yeah. And so give us what your take.
So
on
I think that their findings. This is a relatively brief report here, but their findings are significant. Even though they're talking about a 0.1 increase in occupancy, that still is a lot because we're talking about a swing that's actually the margin is about 3% from peak occupancy to trough. So that that 1% increase is a little bit better, especially comparing to the zero of the previous year, which we can talk about lagging indicators. Occupancy is like so rent growth arguably lags occupancy a little bit, and just from the conversations I've had with property management team at Gray Residential, it's like if your occupancy is hurting, well, maybe you lower the rents and try to attract renters that are, and then if your occupancy is high, then maybe you have more flexibility to increase rents, kind of test something out, and it is worth mentioning that these numbers may not skew, the occupancy numbers on average may not skew very high, but they're the result of these processes that are happening like happening every day. And it's like, I think back to like, so you always see these retail landlords they're waiting for the right price because it's 3 years. But this, the turnover, the churn of apartment units is so fast that like it motivates the changes in prices and the reactivity to what the market is, and that's like particularly interesting. And going back, and I was kind of just looking at the apartment list graphs, and it looks like it's about 2-3 months between a change in the occupancy trends where you see a subsequent change in the rent growth trends. So things are, there is some correlation, I think, there. And the ultimate point that I have, too, is the occupancy trends seem a little bit like right now we're in a multi-year trend for occupancy where things have been going up since maybe October of 2022 up until now. We are now they've been going very, very gradually up, but that's
vacancy has been going up.
Vacancy has been going up. I'm sorry, not occupancy. Yeah. And so
after peaking, I mean, vacancy was a low point, occupancy was at its high point.
Yeah.
First half of 2022.
Yeah, that's a crazy thing too, is that like occupancy was doing great and it started to get bad for a while, and even rent growth started. I remember those years was like, well, it's going down, but it's still quite high, and so we don't need to worry about it. But that's how. Yeah. Rent growth may have done its own little bumps and rejiggering, but occupancy continued to trend down. Vacancy continued to trend up until where we're at now.
I mean, you've hit the nail on the head, Matt. It's not rent growth. It's rent growth does not lead rent growth. That's kind of the tail wagging the dog. It's occupancy, and it's because of the demand or the lack of demand.
Yeah.
If you are if you're 99% occupied and you've got one unit left, you're going to see what you can get for the one unit.
Yeah,
you know, or if you're 100%, and if your new market rents are significantly higher than what you had been leasing at, you know, you're going to increase your renewals, you know, up to market. Versus if, you know, if you've got units that are available, you just need to keep, you know, people living there and people paying, and
for sure,
it's a completely different mindset.
Now,
and that 2 months is interesting.
And this is part of why I did bring up the apartment list one, is because this is the rolling hills of the occupancy trends that you can see visualized right here. They have a little bit dimmer view of occupancy. Maybe they think the vacancy is probably a little bit higher, but you can see from October 2021, actually, it was the low point of vacancy, high point of occupancy, and then right now we are near peak vacancy. But I think signs from RealPage means that things could improve.
Peak. I mean, we're looking at a specific point. I mean, we're back to pre-pandemic levels. I wouldn't really say peak. I mean, peak would go back to the great financial crisis.
Well, I would, and that's a good point. The vacancies could have been, now they only measure since
stable.
2019.
This is normal. We're back to normal. We're not back.
We're a little elevated above normal. So I would say normal is
6.8 to 6.7.
No, I think normal would be like 6.25 in the middle of 2019. I think they're measuring this is their peak vacancy they're associating with the lockdown. But it's not. But that's another good point, though. It's not that far off from normal. What we're talking about is essentially 3 points of difference from peak to trough, and the difference between the relative jump at the beginning of the pandemic, which was a previous measured peak, and the normal of 2019 is like probably a difference of like 0.4. If anything.
I mean, because if things are bad, like in Austin, for example, I mean, you have the average vacancy in Austin right now is like 11%. I think. It's double digits.
Yeah.
And so, you know, if we saw that on a national level, that's where we would be concerned. Or if it was even, you know, 8 or 9%, that would be extreme, and that would not be unfathomable given the amount of deliveries that are going on right now.
And that's a good point too. That and they make that in the RealPage article. They talk about regionally. You know, you're looking at the Northeast and the Midwest as the strongest for occupancy, and places like Austin, Phoenix are doing poorly. Although they are saying even some of these markets that are doing poorly in occupancy, their net difference of occupancy is like positive. If you click over to the RealPage tab. Sorry, I'm still on the.
Oh, you know, you're good. I was just listening to you.
But yeah, they have that, like the net effect of a place like Memphis is very positive, but they're only barely positive when you look at the pure snapshot of the numbers. But a place like Virginia Beach, which had very very positive occupancy in 2023 and now slightly negative, that difference is hugely different. But the whole thing here is we're talking about swings of 1 to 2%. So I think it's interesting how these small numbers are meaningful, and how much then the margins here, whether it's 1 or 2 units you have extra that gives you the flexibility to change, or 10 or 15 that makes you want to lower rents. That's a meaningful thing on the apartment level and on the market level.
I mean, it's a nickels and dimes business.
Yeah.
So, I mean, you know, if even more, I've heard say it's not a nickels and dimes business, it's a pennies and nickels business. and
pennies and farthings. Yeah.
Yeah. And so, yeah, every percentage point counts for sure.
Yeah.
Because, we're usually within a pretty tight band. Okay. Yardi Matrix has a new report out, your U.S. multifamily outlook for summer of 2024, and Yardi always does a great job putting these reports together. It's a long report, Matt, so we're going to get through the whole thing. We're not going to be able to get through the whole thing. I'd recommend if you're going to do that, you sign up for the Gray Report newsletter. Go to graycapitalllc.com/newsletter. You'll get these reports sent to your inbox every single week, every Thursday at 8:30 Eastern. Okay, so but their headline, Matt, is basically on theme and on topic of exactly what we've been talking about all day today, is that multifamily perseveres, waiting for rates to fall. The fundamentals are solid. Not that it's all like roses and everything's like absolutely smooth sailing. You still have foreclosures. You still have people, you know, that have loans maturing. You still have people that are having just major operational problems. But generally, the supply and demand, and again, those are all like, I feel like, individual decisions of individual operators and owners, or ability or inability to manage a property. But like from the demand fundamentals, things are looking really good. But what's going to happen, Matt? Are interest rates going to come down? We're all waiting for rates to come down. Then the floodgates are going to open. Is that what we're waiting on?
It's an interesting. Again, like I kind of alluded to this in the Wall Street Journal discussion. The point here, I'm kind of skipping to this, is that the response in the investment market to higher for longer rates has been lower for longer activity. They're measuring it. They're measuring a 24% drop for year over year in investment sales, and I'd love to know what the kind of monthly or quarterly, if we can have a slice of time that's a little closer to present, if there has been an uptick, but the year over year numbers, they're still showing a decrease compared to last year.
Yeah, I've seen a handful of like syndicated deals that are out there now, but also looking at the market, doesn't seem like there's a ton of activity. I mean, there's deals under contract, but I think it's another question I would be curious asking, and if you're a listener and a viewer of the Gray Report, and if I'm curious if people gotten out of the business. Yeah. If people have just said, I was going to do this, I was going to buy multifamily, I was going to buy some apartments, or I was and I sold, and I can't make sense of it right now. I haven't been able to find any deals. Because you can't just go on if you don't have a self-sustaining portfolio. And again, there's so many different ways to invest in apartments. You can buy a fourplex, you can buy a duplex, which those are technically residential. That doesn't, but same more or less the same thing. You invest as a limited partner. You can be a co-GP. You can be a syndicator. You can be a fully integrated owner operator. There's so many ways to get into it. But, if you have an operating business, and you're often those businesses, if you're not doing deals, it's hard to kind of stay afloat. And some people might not have been able to just keep things going. Yeah. But even if you can sustain your operations, you start getting just disheartened of the market sucks right now. There aren't any deals. And then you just tell yourself that enough times, it's very difficult to find the motivation to look for any deals when you've already believed that there are no deals to find. Yeah. How much effort would you spend looking for things that to not be the case?
Well, and I think especially getting started, maybe there is that point where they're getting or maybe companies are downsize or something. But let us know.
Let us know in the comments if you know of anybody who's I was going to get into this space and I decided not to just because just the timing didn't work out, or if there are foreclosures that are going on. I don't know some of these groups if they're able to fight, live to fight another day, and they're like, no, we're fine. That was just a misunderstanding with the bank, and we're going to be coming back better than ever. Yeah. Or are they going to ride off into the sunset and say, I just lost all my investors' capital. I'm gonna go raise money in another sector.
Yeah. I think that while there are, elements, definitely storm clouds, I also think that regionally there's huge differences. Now, the hard numbers here for the nation is 1.1% year over year rent growth. It's not negative, not as positive as it should be, especially it's the summer. It should be higher than it is right now, but regional performance is definitely different. Now, they say, obviously, metro level rent growth has been led by the Midwest and Northeast. Supply growth has been moderate. And they forecast 553,000 deliveries in 2024. That is compared to the 479,000 that we just got from the multifamily starts data. However, I think that's a reasonable number. Their rent growth estimate is 1.7%. And that's for the nation. Different metros are going to have different numbers. Atlanta, negative 2.1. Austin, negative 4.1 is what they project. Indianapolis is, I think, where is it there? 2.4%. They have national here as 3.1%, but I have since contacted Paul Fiorilla, and he says it's a long story. I'll correct it.
So is the national number wrong?
No. That's
is
just
the
not.
Indy
It
number
was
wrong?
just like a typo in that table. It's no big deal. I have confirmation that I thought I felt a little bit like the Simpsons comic book guy, but I'm a big fan and I just want to make sure everything's on the up and up. But they mentioned earlier in the paragraph their projection year over year is 1.7% for the national average.
I was going to say that makes a lot more sense. I was going to say a 3% projection on rent growth, which is basically what 2023's was, and it was wrong. It's moderate, but it's a little aggressive given the supply.
Yeah, I think that's
just where
actually
the rest of the nation is, and where all these other projections are.
It's Columbus. That's the only one that gets that high. That's the peak. So Columbus is the peak rent growth at 3.1, followed maybe not so far behind is places northeast like New Jersey and Kansas City at 2.5%, Indianapolis 2.4. There are places they're going to beat the average, and it's interesting to see how much the lower end is skewing this. So there's actually a decent handful of maybe relatively smaller markets that are punching above their weight class, but this average is drugged down by places like Austin or Dallas Fort Worth or Phoenix or really even like Tampa. But yeah, all these places, the former hot Sunbelt places, well, it's hot in the Midwest right now.
Yeah, it's hot all over the place right now. And you can see, another thing, again, why I love the Midwest and, in Indianapolis and in Columbus, Ohio, is just, look at the rent levels compared to some of these other markets are so much lower.
Yeah.
And it just underscores the affordability of why businesses are moving here, because, wages are just a little bit lower, and because it's affordable to live here. You don't need to even make as much, but wages are growing. And there's a lot of room to grow, because it's not like wages are that much under where the
and
national is.
They actually did make that point too when they were talking about the regional growth. Is they say these regions have had strong labor markets and economic growth fueled by reindustrialization in the Midwest and return to work locations, including New York and Boston in the Northeast. But I was thinking about this earlier today. Maybe we're overstating how much it's the Silicon Valley of the Midwest. There's so many new things, and
Silicon Prairie.
And I always get
Silicon Valley.
Everyone gets so excited about like the chips plants coming in here, the other factories coming in here, the growth and economic growth in the region, and I think that is happening. But I also think like on the larger picture, they just aren't building as much apartments in the Midwest, and it's like they're neglected, and we haven't suffered. Our economy hasn't suffered, and it's just been humming along, and it is a product of developer neglect.
That's I think a really good point, Matt. Is a lot of these like jobs, the developments, they are like moving dirt to build the factories.
Yeah, it hasn't even happened
right now.
Yeah, the demand hasn't even happened.
The job openings haven't even started yet.
Yeah,
and so it's really more of a story that so the reshoring and the resurgence of manufacturing. That's really more of the like why the next 10 years is a great time to be in the Midwest.
Yeah.
Whereas right now is just a reflection of just the more balanced nature of supply and demand that these markets have been experiencing.
Yeah. Very good point. So it's on whether you're looking in the near term or the far term, there's a lot of reasons for investors to focus on the Midwest. Not the least of which is if you're looking in a market where it may be a little bit more difficult to invest, like it has in this. There's a little section on the multifamily investment market, and they're talking about multifamily sales volume remaining weak, and this lower for longer activity. Well, I could make a very strong argument that where the activity could be is in the Midwest, and there's an article from BizNow that would corroborate it, at least on the level of opinion.
I think you're going to see a marginal shift to the Midwest and into the Northeast.
Yeah.
I still this is completely anecdotal, Matt, but I still hear conversations from investors who are much more doubling down on their just original thesis.
Yeah,
because
of going in the Sun Belt.
Yeah, because and I understand here's the argument is that you're still going to get great growth. You're going to get good rent growth. You're going to get great population growth because the supply will be absorbed. It may take a while in some markets, especially like in Austin, but it will get absorbed, and they're going to be able to grow out of it. Whether this all happens again, another boom and bust cycle, possibly, but is now a good time to take advantage of some depressed pricing. The hard part is, that next 2 years, I know these models don't look good, man, if you put in negative rent growth. When you go to an investor, and if you don't have flat growth, if you're, anticipating higher than trend, you're really going to have a good story. And so I don't know if the investors will get behind it or not, or if just just the long-term story of, okay, we're going to see some growth in the Sun Belt. So I think people are doubling down, but but part of it is, I don't know if there's how much of there is that to it, of like there's something there, or is like I already have my portfolio here, and this is what I've already kind of convinced myself to do.
I've written this section of the pitch deck, and I don't want to have to write a new one for the Midwest.
No, I think there's still a ton of good reasons to invest in the Sun Belt, but again, I think people are discovering that there are other great opportunities elsewhere.
Yeah, I completely agree.
And the Sun Belt's been, has been a little overpriced. I think, the values are down now, but
for sure. You're going to maybe your cash flow or something, and that's I kind of get into it when we're talking about this Biz Now article. But there could be changes. That's what will be interesting. Maybe not. The advantages of the Midwest may shrink compared to the Sun Belt if more competition comes into the market.
Oh, sure. Yeah. I mean, if all of a sudden like Indy cap rates are trading at a 3.8 or 4 and the Sun Belt's trading at a 5, I'd be like, okay, well, this is a little bit overkill. This doesn't make any sense. I mean, you should be able to get, there's been always a nice discount to Midwestern assets, and there still is today. Just how much discount will prevail will be the question. All right. Going on for this Biz Now article, kind of a similar theme. The darling of the party, investors flock to Midwestern multifamily as they flee struggling asset classes. Matt, we've talked about investors maybe investing in the Midwest instead of maybe the Sun Belt, but also, there's investors that were investing in maybe office buildings, maybe some retail they love real estate. They maybe used to see apartments as maybe like risky. And, when I've talked to retail investors and office investors, they're like, I don't want to deal with tenants. I don't want to deal with toilets. And, and then you're like, well, neither do I. Like, neither do
tenants
I.
And toilets are there are a lot worse things that can also happen.
There are. Like no one wants to work in your office building. No, but obviously you have systems for that. And multifamily is much more operationally intensive than an office building or a retail building. Like for sure. But like there are systems. You can hire a third-party property management company. You can do your own property management, hire a manager. Anyway,
I do like
it's
the lead
not enough
up.
not to do it.
And the lead up is a nice, nice little short paragraph. It says that the red hot industrial market is cooling. Retail's biggest brag is now that we suck less finally. Office assets are struggling mightily, to put it lightly.
We suck less.
I know. That's a good, it really is a good headline, and it links to an article that digs into that. But really, this is more about the strength of Midwestern assets. And it's from a perspective, I'll say, on Chicago as their exemplar Midwestern market. Now, I think that there are
It's an interesting one to choose.
I know. Well, that's what I said. It's like sitting here in sweltering hot Midwestern Indianapolis, looking up north to Chicago, that's about 15 degrees cooler than us. It's funny to think that someone from Chicago is commenting on not being cool enough when it comes to getting the attention of investors. But that's a little digression. Chicago's in the Midwest, and its multifamily market's doing quite well. Yardi Matrix actually has their rent growth projections above their national average at like 2.1%. So that's pretty nice. The regional outperformance is nothing new to us, but we just see like Columbus. That's been a real star, and that was the one that has the record for Yardi Matrix. But places like Kansas City and really Cincinnati, Indianapolis. I'll mention again Louisville. I can name a lot of these really strong markets.
I think they don't mention Indianapolis in this article specifically, Maps. They didn't have anybody on this panel from Indianapolis.
Oh, that's probably a good point. But
we're talking about a panel.
Either way, if these properties in Chicago or Columbus, we kind of mentioned this before, or Kansas City, Indianapolis, whatever, if they're looking more attractive to people, that's going to lead to more competition, and more competition, the prices go up, which means maybe, and this is what I was thinking is like, does that mean that it could be just a different, a little bit of a paradigm shift where you're not making as much money on cash flow, you're making more on appreciation, because more people are pouring into the market now. That would be a dramatic shift if things went that way. But the regional differences here. Again, we mentioned places like Austin have negative 4.1% rent growth compared to 3.1% in Austin. Or I'm sorry, not in Austin, 3.1 in Columbus. There is this reason why I think that story is the one that we've told a lot, and also the story about asset classes we've told a lot, and it's an open question about whether these retail investors are still going to stick with CRE and go into the apartment market, or whether and at the same time whether like New York investors will go into Kansas City or Indianapolis. How much of their shift? Not
to paint like all of New York with a broad brush, because like there's a million types of investors and people in New York City, but of all the different cohorts, are definitely some folks who are looking for value, and they understand value investing, and they like the Midwest, and many have liked the Midwest. Not necessarily on the institutional side, but just knowing there's always been like owners from New York and Indianapolis, or California. Not a ton of institutional owners from those markets, a few, but not as many. But there's always been some interest because they've seen the value, and it may be as simple as they're like, oh, I could buy it for a higher cap rate and I can get some cash flow. And didn't dig into all like the nuances other than like literally looking for something that's cheaper that could cash flow more. But it will be interesting because if the Midwest becomes more of an institutional market for investors to invest in, we would see more cap rate compression, and that kind of the return profile switch a little bit more onto the appreciation side with some cash flow, but slightly less cash flow. And so, you always have these markets where, you have to, your return is an equation of your yield and your capital gains, the difference of the value. And, some investments can be all capital gains. You're just looking at appreciation, and some can be like very little capital gains. It's not really an increase in value, but I'm going to get a lot of cash in the meantime. And so, but you add those two together, and that's your return. And so, in the Midwest, that return has been a pretty good balance between appreciation and cash flow, but more skewed towards cash flow than some other markets. The Sun Belt used to be just like that, but it shifted to more appreciation as cap rates compressed and values went up. And then so you're investing not necessarily in the cash that it produces today, but the hope that it will produce more cash flow down the road. And so, but I'm just thinking of the investors in 2021 that invested in Austin at a 3.5% cap rate or 4% cap rate. Compare that to the investors that invested in Columbus, Ohio at a being realistic, 4.5% to 5% cap rate, still low cap rate today, but meaningfully higher than it would have been the Sun Belt. But the growth over the next preceding years, just this year alone, you're looking at getting negative 4% in Austin, 3% in Columbus. That's a 7% total swing. You're doing a lot better in Columbus. Yeah, that is interesting too. And the way that you kind of mentioned it before, it's like it's a spectrum of markets where it's going to be more, looking at cash flow versus appreciation, or like it's almost like there's like a mature markets. And I wonder if, is that the way that maybe the nation would progress, the national market progress from cash flow to a more like appreciation, a less risky investment? And are these Indianapolises going to turn into
going to turn into Chicago's? Are these Chicago's going to turn into New York's? And are these Kokomo's going to, or West Lafayette's turn into Indianapolis's? Like, it is interesting to see how things are going to progress. And I know,
that's how it is in a lot of other countries. I mean, some countries, like maybe in like Central and South America, it may be more on cash flow than appreciation. But then you go to like a country like Europe, a place like Europe,
countries like those in Europe,
a monetary federation, the European Union, where it's much more skewed towards appreciation. There's not much cash flow. You're seeing institutions pile into those assets to preserve their wealth, so they're relatively steady. They do appreciate because there's a limited amount of it. It's hard to build and et cetera. But you're not necessarily doing it for the cash flow. Getting really low yields, but
that's
potentially high returns and low returns in general in Europe.
I think of, and I don't know if it was Carl Whitaker that you said was mentioning it. It may have been a LinkedIn post, but he was talking about places like Indianapolis. Maybe they're going to look more like Nashville in terms of, the growth and the amount of investment that's going into the city. So it's exciting. Like I said, I'm probably overly excited when I hear about these things that are just for example, that are happening in Indianapolis. We're building a new hospital complex, there's a new Eli Lilly, and there's a new chip making plant, and I know all about these things. I'm so excited about them. That may be normal for any other big city, but it just shows that these places are still growing, and they'll continue to grow, and it's only a matter of time, I feel like, before people start noticing and start investing in that growth.
I think they are. I think they finally are. I mean, as we're seeing these articles being written. I mean, again, this is stuff that we've talked about for years, Matt. I've talking about notice for even more years than we've been doing this show. It's nice to see these articles finally be written and talk. Where the bell of the ball, the glass slippers going on the feet. That's nice.
And to cap off the optimism, even beyond specific Midwestern multifamily, there was a data point. I just forgot to put the full report in here, but it's worth mentioning this. There's a Freddie Mac Apartment Investment Index, and they posted like a sharply strong quarterly gains, and it doesn't measure the year over year. It's just saying the quarter one of 2024 had it looked better for investors than the previous quarter, and that's a strong positive
relative
trend.
To prices, interest rates basically being where they are. I mean, treasuries have come down a little bit in the last month or so, but cap rates have finally come up. Not across the board, but many sellers are finally deciding, okay, this is just where the market is.
And that's the counterpoint, I think, to the Yardi Matrix point of, I think a lot of sellers are lower for longer activity is fine by me. But on the flip side, there are signs in not exactly a chorus of other voices, but definitely a group of people are thinking, well, maybe now's the time to invest. And you look to the future, and that it does look pretty sunny.
Yeah. The other thing going on in Indianapolis, Matt, is the U.S. Olympic team swim trials. They're going on. Kind of exciting thing that's happening. And Great Capital's own Blake Peroni has been competing there this week.
We've been watching him.
We've been paying close attention. If you're an investor at Great Capital, you probably have heard from Blake, worked with him.
He doesn't really brag on it a lot. He doesn't really call up people and say so. It's probably a surprise to a lot of people.
He will not bring it up unless someone else brings it up. I've been on calls with people who say that, like, I tried out for, like in the intro meeting, they're like, and I've tried out for an NFL team, or like I played a season in the NFL, or like I played whatever college ball, which is awesome.
Here's a chance, Blake. Does he chime in and one up him?
Big accomplishment. Blake has gone to 2 Olympics. He's won 3 gold medals, and then he's also won like a dozen other major swimming awards. And I mean, he's one of the top 10 fastest swimmers of the the 200 or the 100 in the country. And, so top whatever in the world. Very fast, very. And you won't hear him talk about it. And unless you bring it up, I have to bring it up. Just because it's an interesting point to learn about somebody. About their background. But we're all incredibly, proud of what he's been able to accomplish. I mean, he retired from swimming. From professional swimming. He's like, no, I'm just going to focus on my career, working at Great Capital. And then he did like a kind of an exhibition, just like a swim meet to do, because he obviously loves swimming. And he did like much better than he thought. And this was like he wasn't training, he was rock climbing with us and just, hanging out with the Great Capital team, working. And he was like, oh, wow, I'm actually still somewhat competitive.
Yeah.
And so he started training again and down with the IU swim team, because he lives in Bloomington. And he qualified this year again, and to go to the qualifications, and he did really well in the 200-meter freestyle relay. And I think he's going to be. It's not confirmed yet because the way they pick out. But he came in sixth, and so they take the top six. Usually, it's 4 on the relay, and they take 2 alternates. I think he's making the team to go back again to Paris this year.
Yeah, that's great.
And may actually get to swim. So it's really exciting.
Yeah, and it is funny. Like he doesn't he doesn't really like wear it on his sleeve, and it is like so impressive how he's also like works really hard at his job too.
Yeah, Andy's like
not
Andy's
slacking,
like a smart guy.
and he's waking up at like 3 or 2 or whenever it is to get his huge swims in, and then he goes and does a full day of work. So yeah, it's really impressive.
Yeah.
Cool.
All right, Matt. I think that's all we've got on the docket. So let's all. So if you got to this part of the episode, definitely give a root for Blake in the. I don't know if he's swimming. I don't think he has any more swims in the quals. But at the Olympics, make sure you're rooting for Blake. If you know Blake, whether you work for him, you're a Great Capital investor, you can shoot him an email, tell him he did a good job. We're all really proud of him. And make sure you liked and subscribe. Like this video, one, if you thought it was decent. I think you can dislike the video if you don't like it. I'm not going to tell you to do that. But you know what? We want just honest feedback. So like or dislike, give us some feedback. Leave a comment. We're going to get back to you as soon as possible. You might even feature it on the show if it's a good one.
There's a couple that we got to talk about next week. So
yeah, there are a couple. I was reading them through before we went on today.
Yeah.
And then we've got a deal. If you like what we talk about and you think that I might want to learn more about what these guys do on the investment side, because that's what we do. We don't just talk about real estate. Well, no, we do talk about real estate all day, but we don't do a podcast as our main job. This is like the thing we get to do for fun, and it helps us talk to you all. But we buy managed apartments. We're vertically integrated, multifamily investment company based out of Indianapolis, and we are in the process of buying beautiful apartment building at a great price in Indianapolis. It's called Solana at the Crossing. You can learn more at solanaindy.com if you were an accredited investor. You got to be an accredited investor. So says the SEC. Screw those guys. I don't like the SEC. I don't want anyone to get screwed over. I just don't think they're really protecting anybody from getting screwed over.
Accredited. You're probably.
You got to be accredited. You got to be accredited.
Yeah.
All right. Thanks. Thanks for watching, everybody. We'll catch you on the next one.